Imagine building a fortune worth billions of dollars, and then watching it collapse in just a few days. Not because you suddenly became poor, not because someone stole your money, but because the entire structure holding your wealth together suddenly broke. This is the story of Bill Hwang and Archegos Capital Management, and it's one of the clearest examples of how someone can control billions of dollars without actually owning billions of dollars. To understand what happened, we need to start with one simple idea. Leverage. Imagine you have $10. You borrow 90 more. Now you can control $100. If that investment rises by 10%, your $100 becomes $110. You made $10, but remember, you only started with 10. That means you just doubled your original money. Sounds amazing. But now imagine the investment falls by 10%. Your $100 becomes 90. The 90 you borrowed still has to be repaid, and your original $10 is gone. That's the dangerous side of leverage. It makes you look extremely successful when things go well, but when things go wrong, it can destroy you incredibly fast. And Bill Hwang understood leverage very well. Hwang was already an experienced investor. He had previously managed a hedge fund and built a reputation in the financial world. Later, he created a family investment office called Archegos Capital Management. At first, Archegos wasn't an enormous empire. But then something unusual happened. It started growing incredibly fast. During the year leading up to March 2021, Archegos' value exploded. According to the SEC, the firm's assets and trading exposure reached extraordinary levels. At one point, its total market exposure was estimated at around $160 billion. Think about that number. $160 billion. That's more money than most people could ever imagine. But there was a problem. Archegos didn't simply have $160 billion sitting in a bank account. It was controlling huge positions through borrowed money and financial contracts. And that's where the story becomes dangerous. Archegos used a type of financial agreement called a total return swap. The name sounds complicated, but the basic idea is surprisingly simple. You don't necessarily have to buy the entire stock position yourself. Instead, a bank can hold the underlying shares while you receive the economic gains and losses from those shares. You put down some money as collateral. The bank provides the rest of the exposure. And suddenly, a relatively small amount of your own capital can control an enormous position. This is extremely powerful and extremely dangerous because when the market rises, leverage makes your gains enormous. But when the market falls, the same leverage works against you. And Archegos had built enormous positions in several companies. For a while, everything looked perfect. The stocks were rising. The portfolio was growing. The banks were making money. And Archegos was becoming more powerful. But there's a psychological trap hidden inside success. When a strategy works again and again, you start believing the strategy is brilliant. Then you start believing you are brilliant. And once that confidence grows, you take bigger risks. That's exactly where leverage becomes dangerous, because the market doesn't care how successful you were yesterday. It only cares about what happens today. And in March 2021, the market started moving in the wrong direction. One of Archegos' major positions was ViacomCBS. Its stock began falling sharply. And when a highly leveraged investor sees a major position falling, something very important happens. The banks start asking questions. They want more collateral. They want protection. They want their money back. This is called a margin call. And a margin call is one of the scariest things that can happen to a leveraged investor. It basically means you need to put up more money right now. If you can't, your positions can be sold. And that's exactly what started happening with Archegos. The firm didn't have enough cash to satisfy all of the demands, so the banks began selling its positions. But here's the problem. Imagine owning billions of dollars worth of stock. Now imagine being forced to sell all of it at once. You're not selling because you found the perfect price. You're selling because you have no choice. And when billions of dollars worth of shares suddenly hit the market, prices can collapse even faster. That's what happened. The selling created more pressure. The falling prices created more losses. The losses created more margin calls. And the margin calls created even more forced selling. It became a financial domino effect. One piece fell, then another, then another. By late March 2021, Archegos was collapsing. The company that had controlled tens of billions of dollars in market exposure was suddenly unable to meet its obligations. Banks began taking enormous losses. Credit Suisse lost billions of dollars. Nomura also suffered billions in losses. Morgan Stanley and several other banks were affected as well. One investment firm had created a chain reaction that spread across some of the world's biggest financial institutions. And this is where the story becomes much bigger than Bill Hwang. Because Archegos wasn't simply a story about one investor making a bad trade, it was a story about how modern finance works. You can have a small amount of actual money and use it to control a huge amount of assets. You can create enormous wealth on paper. But that wealth can disappear just as quickly when prices move against you. And there's an important distinction here. When people say someone lost billions of dollars, it doesn't always mean billions of dollars in cash disappeared from a bank account. Often, what disappeared was market value. Imagine you own something worth $100. Tomorrow, the market decides it's worth $50. You didn't physically lose $50 from your pocket, but your asset is now worth $50 instead of $100. If you borrowed money to buy that asset, the debt doesn't automatically fall with the price. That's the problem. Your assets go down, your debt stays, and your equity gets crushed. This is why leverage can be so dangerous. The higher the leverage, the smaller the mistake you can survive. And Archegos was operating at an enormous scale. But there was another problem. The banks working with Archegos did not necessarily have a complete picture of the firm's entire exposure. Different banks were dealing with the same client. Each bank could see its own relationship with Archegos. But when you combine all those positions together, the total risk becomes much larger. This is one of the strange things about financial systems. Sometimes, the biggest danger isn't inside one company, it's in the connections between companies. One investor depends on a bank, the bank depends on the investor investor depends on rising asset prices, and everyone assumes the system will continue working tomorrow, until suddenly, it doesn't. The SEC later accused Hwang and Archegos of fraud and market manipulation, alleging that the firm misled counterparties about its positions and exposure. The case became a major example of the risks created by extreme leverage and concentrated positions. But there is an even deeper lesson here. We often look at wealthy people and see the number. $1 billion, $10 billion, $100 billion. But the number alone doesn't tell you the story. You have to ask, how much of it is actually yours? How much is borrowed? How much is based on the current market price? How much leverage is being used? And what happens if the market falls 20%? That's the question most people forget. Because when everything is going up, leverage feels like magic. You can turn 10 million into 100 million, 100 million into 1 billion. And suddenly, everyone thinks you're a genius. But when the market turns, the same machine works in reverse. The losses become larger. The pressure increases. The banks demand collateral. Positions are sold. Prices fall, and the entire structure can collapse. Archegos is one of the clearest examples of that process. It also teaches us something about human psychology. Success can make people underestimate risk. If you make money 10 times in a row, you start believing the 11th trade will work too. But probability doesn't remember your previous victories. The market doesn't care that you were right yesterday. And that's why some of the biggest financial disasters in history happen after periods of incredible success. People become confident. They borrow more. They take bigger positions. They stop thinking about what happens if they're wrong, until eventually they find out. The collapse of Archegos happened incredibly quickly. A company that had built massive market exposure suddenly couldn't meet its obligations. The banks began selling, the prices collapsed, and billions of dollars in losses appeared across the financial system. It's a perfect example of a strange truth about money. Sometimes, the biggest fortunes are built on confidence, and the biggest losses begin when that confidence disappears. So, what should you remember from the Archegos story? Not simply that leverage is dangerous. The bigger lesson is this: looking rich and being financially safe are two completely different things. A person can control billions of dollars and still be extremely vulnerable. A company can have enormous assets and still collapse. An investment can look incredibly profitable until someone asks for the money back. And that's why one of the most important questions in finance isn't, how much money do you control? It's, how much risk are you taking to control it? Because sometimes, the difference between $1 billion fortune and a financial disaster isn't the amount of money you have. It's the amount of debt underneath it. And that is what made the Archegos story so extraordinary. A financial empire grew to enormous proportions. Banks trusted it, markets rewarded it. Leverage made it bigger and bigger. Then a few major positions moved in the wrong direction. Margin calls arrived. The selling began. And within days, the empire was gone. The lesson is simple. Leverage can make you rich much faster, but it can also make you poor much faster. And, in the world of finance, the most dangerous moment isn't always when you're losing money. Sometimes, it's when you're winning so much that you stop asking how much you're risking.